A number of representatives here from Moore Stephens. My name is Paul Breeman. Russell Barnes, we've got here, another partner, Varun Kumar. He's our manager of Walga Tax Services, so any tax questions can be, and David Tomasi, I'm sure most of you know David, from the audit perspective. So we cover a range of technical issues in local government. Hopefully we can, whatever the question is, we'll sort out who answers that, come forward onto the platform here and do that. Now, Dean, I believe that you've got the text, any text questions coming in from the streaming. Sorry. So please put up your hand. I think if we do this in a fairly structured sort of way, if you've got a question, put your hand up and please wait to ask that question until the microphone comes over to you so that everyone can hear it on the streaming session. So let's start.
My question is a tax-related question.
Thank you.
Yep, no worries. As a local government, is there any tax benefit if we adopted the reverse-novated lease for the fleet or some of the employees instead of a conventional novated lease?
Okay, so the reverse novated lease agreement works in such a way that both from an FPT point of view, like during the time of the lease, it's the same treatment, but at the end of the lease, when the car gets sold to the employee effectively, there might be a detrimental FPT effect of that. So you'll actually have to go and check your lease agreements and who gets ownership of the vehicle and termination of the lease. And based on that, you'd have to figure out whether you'll have FPT payable at the end. So, but
right.
Yeah, during the time of the lease, it's the same.
Right. At the end, you said that there's a detrimental.
There could be.
Detrimental FPT implication. Is it positive or negative?
Negative.
Negative.
By negative, I mean FPT may be payable.
All right, thank you.
Next question.
Peter from East Fremantle. Probably a question for Russell. I know we've discussed this one before, but I just wanted to get your thoughts on the relevancy of the financial health indicator, I guess matrix and score as a barometer for the financial health of local government.
Thanks, Peter. Yeah, we have obviously discussed it a bit before. I think there's a couple of things in relation to the ratios. Ratios fundamentally are meant to show things. They're meant to highlight differences between entities or differences over time. So the ratios in themselves will highlight those. So we've got things like the impacts of the FAGS grants and those types of things that are clearly shown through the trends that are coming out in the ratios. What is interesting is when we apply a fundamental benchmark to those ratios and then start to rate organisations against that benchmark. And I think that's really where a lot of the problems are coming from in terms of the use of the benchmark and obviously the financial health score, where we now add a weighting to that and we start getting performance indicator driving behaviour and not always positive behaviour. The other important thing to note is some of those ratios have short-term indicators like the current ratio, whereas other ratios have significantly longer-term indicators. So the ratios need to be considered in the context for which they're designed. There's obviously the weaknesses in terms of things like reserves not being monitored through the ratios and those types of issues, but in themselves, yeah, there's deficiencies, but there's deficiencies with any particular ratio. That's why we have a range of ratios. Next.
I had one question regarding one of the changes to the GST regulation relating to residential properties. If you could explain about it.
Yeah, sure. So it's not a change to GST law, it's the change to the collection of GST. So in summary, what now is required is the purchaser at the time of buying new residential properties, so this is newly built properties or substantially renovated properties, are required to withhold 10% withholding at the time of purchase and remit that to the ATO. Okay, so basically what was happening is you had an activity called phoenixing, where a lot of property developers were coming in, they were claiming all GST and all the construction costs, and at the time of sale, what they do is they'd liquidate the company, so they would never pay the GST to the ATO, and the ATO lost like $2 billion or some $3 billion in revenue because of that. So they've kind of introduced this new collection mechanism so that the ATO get the money up front at the time of settlement. So yeah, so now there's an extra liability at the time of settlement of new. Just remember, it relates to new residential premises, which is either they've been built in the last 5 years, or it's a residential property that has been substantially renovated. Okay, and it also might apply to newly subdivided residential property as well. So there are a couple of new things to look out for.
I've got one question that's been texted in. When the council has appointed a panel of suppliers, can we choose any one of the suppliers to provide the service, or do we have to get quotes from the panel in accordance with policy?
Obviously, Dean, if they've got a panel of suppliers and we're talking about utilising that panel to exempt from the tender regulations, they've got to follow their policy. So that they need to have a policy relating to how they deal with that. There's also requirements around what goes out in the actual tender documents when they call for submissions and for people to join that panel. So that, yes, definitely would need to comply with the terms of that when they've called for the panel members and with the policy that is associated with it.
You guys have been around for a long time and you travel far and wide the length of WA.
And breadth.
Sorry?
The length and breadth.
Yeah, okay, and the breadth, yeah. I guess we heard this morning from the Auditor General's office that they're essentially going to start benchmarking local governments. They're going to start putting comparative scores. A few years ago, we've seen the leagues tables come out in my council numbers and put comparative numbers against local governments. Do you believe, in your experience and your travels going across, that you are seeing a manipulation, if you like, or an adjustment to the reporting of some of the statutory financial information? For example, local governments might adjust their depreciation schedule rates and those sorts of things on the basis of trying to improve a benchmarking score, so we shift away from essentially proper financial management, if you like, of local government to moving towards a benchmarking and an improvement of reputation of local government in a public context.
I'll give that one a go. Thanks, John. Yeah, I think it's interesting because we do get to see, as you say, we get to see a lot of local governments, and over the years we've got to see a lot and how trends have developed. And whilst, you know, the way the ratio system operates, there is scope to try and manipulate, you know, the ratios if you really want to, or whatever, if you want to try that. But when you start to dial down into things like depreciation and, you know, asset valuations and different things, now that we're in the fair value regime, I don't think it's as easy because you suddenly lose a little bit of control. It's not about a decision anymore to say, let's take a loan out or something like that. That is a council decision which they're entitled to do, and maybe it was an officer that thought to bring that up to the council to achieve something. But when we get to things like fair values, they are, in theory, supposed to be reviewed by a process an internal process as well as an audit process, and then the same with depreciation. And many of you who have been to our workshops over the last several years will understand that we've been saying for a long time now that there needs to be a real focus on our RULs, our remaining useful lives, and the condition reports that are going into those valuations, mainly because a lot of that impacts back out on the depreciation side. So in theory, if we're all doing our job properly, and that includes officers, valuers and the auditor, then that shouldn't be possible to sort of get there. And over time, we should become more consistent across the industry. And I think if stepping back for a moment and just thinking, okay, as a firm of auditors, maybe the OAG coming in, we could say, they're coming in and in on our turf or whatever. But what it'll actually do is provide a greater consistency, particularly in that area, or hang on, it should provide a greater consistency. So rather than us starting to have people try and pull away and manipulate more, there'll be less scope for that and less room for that on some of those big ticket items. So that's where, and as from a personal viewpoint and, more or less as a spokesman for the firm, I would say that that's something that I'm hopeful will start to happen. It will help us drive some of the behaviours around those depreciation rates that fall out of a proper review of the valuation process and remaining useful life. So that's as an example. And so that then will follow on into other areas as well, but that is a particularly large one that affects a lot of the numbers that are in. Well, the bottom line, for instance, gets affected by depreciation. If that's 3 million or if it's 8 million, there's a big difference. So, and look, we do see some differences like that. So hopefully that gets better. Paul?
Thanks, Dave. Yeah, I've got a comment on that. David's looking at it from the audit perspective and undertaking that review of what's happened. We also do a lot of work in long-term financial planning and asset management, and we see that particularly a lot of the elected members are driven by the targets that are within, or published by the Department of Local Government and inherent within the financial health indicator. So when they're doing that planning, they're very much asking us, we want to do this plan, but we want to make sure we hit the targets and we improve in all of these different areas. And potentially they want to do that without an increase in rates or spending more money or all of the other things that come along with that. So we see those pressures basically looking forward as a large part of these league tables or rankings can have an impact in the past and in the forward planning. Okay.
Hi, what would you see as best practice in long-term financial planning? Have you seen any good examples of council long-term financial plans? What goes into constructing a really good long-term financial plan?
Okay. Yeah, that's a pretty big question. It's a pretty broad question. Okay. So let's see if I can give you, a fairly the benefit of the experience that we have in this area, and that is that you really can't do long-term financial planning in isolation. You must do it at the same time you're doing your asset management planning. Okay, so asset management planning and long-term financial planning, right, are really not two separate components, if you like, of integrated planning and reporting. We see that doing them in isolation is the biggest mistake in that process. It really has to be an interaction, a close interaction between renewal timings from your assets, fixing those levels of service if you can, if you have that information, right, and then comparing that to your financial capacity. Now, if your financial capacity is not enough to do all of what's called the required renewal and the required renewal timings, then you need to try and work on issues about how long you keep those assets for and put in place strategies to push out the renewal timings to a point that you can afford it. Now, that might be additional maintenance through the long-term financial plan, but basically the levers that you've got are how long you keep the asset for, right, which impacts on the renewal timing and future renewal timings. So my biggest advice would be try and do these processes in tight integration.
Should be wearing one of those little step things. Paul, main roads collect data from us, and then I think it's Chris Berry formulates it and gives the councils back their main road data as to the life on the condition rating of your roads. Do you see that that's information that we can be utilising rather than creating it ourselves, or is it just something that's too hard, it's not audited, etc.? Any comments?
Is it Chris that puts it together? Used to be, that's through the Walga road expenditure report, is you referring to?
Yes, that's right.
Okay. I've seen those reports. It's a good overview. I think that's what it is, right? It's not individual condition ratings on roads, which, is a large part of, having a detailed future renewal timing schedule, if you like, particularly for roads. Okay, so I'd suggest that individual circumstances need to be taken into account. I mean, I really can't provide advice in any other way. There's not just a simple way of saying this is the way it is across the whole state. Even though that road expenditure report does separate it into the regions and into the categories, and it's a good way to make comparison, it really is an indicator in the same way as Russell was mentioning. It's an indicator, and that data should then be a pointer to looking at the detail, okay? And then going in and being an indicator for that detail. So it's not in the same way as financial reporting indicators aren't. They aren't an end result or a means and an end. It is just a case of saying where to look, as the previous speaker was mentioning. Data is just, and I thought that was a very good point, data is just, right, a indicator as to where to look. And then you've got to go and look and make sure that the information that you're using as part of that long-term financial plan is relevant to your circumstance.
We've got a question. With the review of the Local Government Act, is it a realistic possibility for smaller councils to have reduced or simpler annual financial reports? Will this be possible, also taking into consideration the Australian accounting standards?
We wish. Unfortunately, I think the Local Government Act is a bit of a one-size-fits-all, and I can't see, certainly, okay, with a review of the Act, perhaps they'll start to give us some stratification on some of the things, but financial reporting, no, I don't think so.
So I'd just like to add there, I think the point was made earlier about the reporting requirement for charities, where a charity with turnover of $1 million has got to do a general purpose financial report. Your smallest local government's got turnover of $2.5 million. So, I don't think there's any possibility that requirement's going to be reduced. Certainly from the comments the department made this morning.
Also, I know we haven't discussed this a lot recently, but with regards to related party transactions, how much checks and balances do you as an auditor do when it comes to related party transactions and declarations?
Yeah, good question. I think, and just like to say thanks to Russell, because I missed that bit when the department were talking about that this morning. I think I was outside, or I might not have been here yet. I can't remember because I got here late. So so just going back to the related parties, well, actually, perspective is to actually look at, okay, firstly, what is your policies and your procedures around the declarations and the information gathering. So we look to see that you've got a reasonably robust system, and how have you a robust system which includes the policies and procedures, and then annually how you communicate that with your elected members, and also how you reinforce that annually, because it is an annual thing. Unlike the annual report and the annual return and the primary returns, where you only really have to update for changes with your related party disclosure declarations, we like to see you actually collecting the information each year, and that people understand, the elected members and anyone else that's related needs to make the disclosure, understand that, yeah, we have to declare any related parties in relation to this whole year. It's not just something, yeah, it happened last year, so I don't have to worry about it this year, you should know. So we look at those sort of procedures. We don't necessarily go out there and try and drill down like a long way into it to do any auditing of any of the declarations. But, you know, if we look at it and say, well, we think your system's a little bit deficient, we might then ask you to do more work. But there has to be a level of understanding, and we would expect there to be some sort of educational support at some part in the process as it's required. And I know, I'm not sure if your query is coming from here, but I know that the Office of the Auditor General, the OAG, has mentioned in public that perhaps that process hasn't necessarily been, or actually it's certainly mentioned to us as auditors, that there are areas that they are concerned may not have been audited well enough in the last couple of years, since the advent of it. But I think that might be some instances of that occurring. You know, across the board, it's not necessarily a generalisation from where I sit or from what I've seen. But, you know, that's certainly not from our perspective. We have a robust look at it every year.
Okay. Hi, I'm Kevin from City Accounting. Paul, when it comes to improving the financial sustainability of councils, particularly around the sharing of the cost of assets across generations, what do you think is a good strategy?
Okay, another easy question. Before I get onto that, and then hopefully I'll have put you off track, and I won't have to answer that question. But before that, I just raised that point that was made today about debt and local government debt. Okay, and I found it a little bit strange in the second review. I'm going, where's the drive for this? That, you know, local governments are not getting debt approved through the Treasury, so we need to actually identify individual assets to mortgage and put the security against. I'm not sure that there's a problem that is there that needs solving, right? And you know, how many people have been refused by Treasury when taking out a loan, right, because of a security issue? And if it is, it's because they're concerned about the financial sustainability of the council going forward, and you know, the extent of capacity to repay. But from my experience, you know, particularly in the smaller councils, in the rural areas, a big driver as to why not to borrow is because you don't know when you're going to get a grant for that project going forward. You know, if you could be sure that you weren't going to get a grant, or if you could be sure if you were going to get a grant, it would be at a certain period of time in the future, then you could manage your debt better. You wouldn't be putting off borrowing it, hoping you're going to get a large grant from CSRFF or whatever. Because as soon as you borrow, you will never get a grant to help you pay for it. So that's a large barrier to debt, right, and taking out debt. And I think that's a large driver as to why local government's a net saver when it comes to that. So, intergenerational equity and that issue. I like to think that with debt levels being, or interest levels being quite low right at the moment, that should be a bigger driver than it has in the past, and should bring the question about borrowing and repaying into the decision to a greater degree than it is. But local governments are, 140 of them, they've all got different circumstances. Some large growth and high level of growth, some decline, right? So I can't really say in one hit what is better. Certainly in the fast growth, you're looking at borrowing, right, to provide assets to generate that, meet that demand, right? But in the wheat belt, where you've got families, very stable population, there isn't that same driver to go out and borrow, right, to build the asset. They would rather save up, right, because it's a stable population. It's the same people paying for it. So there's some variables in there that make that one solution not possible to tell you, okay?
John, I just want to go on that side first.
It's Paul here from Mandurah. Just on the bit we talked about with debt there and Treasury Corp, are you aware of any local governments that use debt outside of Treasury Corp? And do you see any issues with that?
Not recently. I have in the past. I've seen borrowings from a bank in the past, right? But that was going back a long time, and like I started in 1979, we would have been back in the early 80s. Yeah. That's right. I started here actually at the City of Canning. Okay, but there's no barrier. In fact, back then it used to be you go out to 3 or 4 banks and Treasury and see if you could find the lowest rate. I remember that happening.
So there's no issue with the rate that the bank's giving you? It's in line with the Treasury Corp?
No, you can borrow from whoever you wish. Yeah, but the security issue, David's right. The security issue, the bank may not be as easy with issuing a debenture, which is a security against future revenue, being rates and general purpose income or general funds under the Act, 621 of the Act, I think.
I'm Bimsar again from City of Wanneroo. Probably this question is for David. Regarding land under roads, I know this financial year OAG is happy to not to report land under roads, but what's your view going forward would be in terms of local governments reporting or not reporting land under roads?
Well, the way the standard and the regs are written at the moment, the standard actually says we should, but the regs actually give us an exemption. And in the past, because of the view that I suppose the regs have had and the department were happy to accept no qualification in respect to the fact that it wasn't in line with the with the accounting standards, or make no mention of that anywhere. Obviously, the OAG had a different view on that, and they have said, well, actually, we need to make a note of that because it's not technically in accordance with, what our accounting standard requirement is. So we should mention that. That's why the reg amendments that were gazetted right at the end of June changed the way the CEO statement was said, and also the draft. And I'm not sure if anyone in this room's had a audit report issued as yet. And I'm judging on some of the comments that were asked of the rep from the OAG this morning that probably they haven't. But there will be an emphasis of matter note that's made in the audit report, just noting that. And for the time being, that's how they're going to be happy with going forward. So until the reg gets changed, the regulation in the financial management regs gets changed that says that, removes that requirement not to recognise it, we'll probably going to continue on that basis, just with the notification in the audit report and in your note 1 to the accounts, and the CEO just has to highlight it. But for that to change, we really need to change the reg. And hopefully they don't, because then we'll have to go back to working out what our land under roads is. But that's from a practical view.
Paul or Russell, asset management. I guess one of the bugbears or the chestnuts of the finance manager is the asset management science that comes out and says the asset gap is whatever number that is, like a large number. And then when that number comes back into the planning process to then try and fund an asset gap, that in my experience is often unachievable in that purest asset management number. And then there has to be a reconciliation somehow in the organisation between the asset management number and the physical dollars and cents you have in a realist terms to actually fund. I know that comes down to levels of service and all those sorts of things. There are many local governments that don't have the capacity to figure out levels of service and those things, and it really comes down to, well, this is what we've got and this is what we can afford to do. Is there some science outside of level of service, in your view, in a pragmatic context that gives some direction to junior finance staff or finance managers in local governments that could come around and try and have a reasonable reconciliation between an asset management gap that is simply unachievable in a financial management context and the day-to-day operations of a local government?
Thanks, John. Paul's breathing a sigh of relief. No, I think when you refer to an asset management gap, there's a couple of different types of gap. There's obviously existing asset gaps, where this level of service that the assets that you currently have is below what your community expectation is and what your community believes that they're paying for. That's obviously a historic issue that's arisen, and there's certainly enough local governments out there that do have those. How much the value is of those is a very debatable number. In terms of science, I'd say to you, is engineering a science? And is the valuation of assets a science? Definitely not. There can be some science behind it, but you've only got to look at what happens when you put out a tender for construction of an asset. You can get, on $1 million project, you can get $1 million variation between the highest price and the lowest price. Yet we're taking one value and saying that's the value of that asset. When we go out to industry in a tender, we get a big range of values. So there is no hard and fast in terms of the values. And really the issue, and was Paul was raising earlier, the benefit of doing an asset management plan and long-term financial plan together is at the end of the day, how long you keep an asset is your decision. It is the local government's decision. Do you keep your cars, change them over every 2 years, every 5 years, every 10 years? That is a planning decision that should be made in the context of your financial capacity to replace those assets. Obviously, the variable in that mix is risk. If we extend out the lives of an asset to a point and beyond the optimum, we're just increasing the risk of failure of that asset. There are buildings around in Europe that are 1,000 years old, still in use, still meeting a level of service. Yet most of the building valuations I've seen in the state got 50 years. There's buildings in the state that are more than 50 years old that are still in use. But most asset managers and valuers will come along and say the maximum life on a building is 50 years. There's a blanket 50 years applied to a building. It's really up to you as to how long you plan to keep that asset for, and understanding as far as possible what the impacts of that decision is. So in terms of junior officers, it obviously, do they have that knowledge? Most engineering guys that I've dealt with, do they really know and understand what future traffic volumes and traffic weights are on the roads? I know I was talking with Nils just the other day, and we're talking about the traffic volumes in and out of the grain bins in Mingineu. They're paying no rates because it's CBH, but the trucks are smashing the roads because there's a huge volume of grain coming off. We're now talking about weather forecasting to predict grain volumes for the next 10 years to determine asset replacement requirements. That's when you start getting scientific about it. We're a long way away from that. But I know certainly Paul, when he was done Esperance, and Esperance have done a lot of work in that regard, where they've actually got quite substantial science behind their estimated remaining useful lives on their roads and how often they need to renew those roads. But it's really tying it back between useful lives, how much money you have, and back in through the depreciation, and the depreciation becomes the connector.
Thanks, Russell. I'll just finish that with a little bit of a different tack, and that is that if you're faced with a large gap, renewal gap, and whatever time happens, whether it's now or a future renewal gap, sometimes it's just impossible, as you say. The financial capacity is not there. The political will is not there to actually say we're going to raise rates and put the money in a reserve. And in any case, if you do that, you are taking money off people now to pay for something in the future that may or may not happen. You can't tell whether it's going to happen, and you can't tell when or how much money you're going to need. So it's a big ask, right, for any council to do. In some circumstances, we've worked with wheatbelt councils, and the grain freight route, I should say, is causing them a lot of problem, and the future renewal timing of that is something we've identified. And the council that we were dealing with just said, okay, we can see now what the task is in the future for that renewal of that road if those volumes continue to be there or they increase or whatever it might be. We're going to do our planning and say, okay, we've made the decision that we don't necessarily feel it's our responsibility in total to do that, to renew that road based upon it being an economic benefit to the state and a few other sort of issues. So they've identified in their planning that they're not going to renew it, and have stated in their plan that they don't feel they have the financial capacity to do it, or that responsibility shouldn't just be on their ratepayers to do, okay? And then have tried to communicate that through to decision makers at a state level.
Hi, Vanaja from City of Netherlands. Just going back to the bank loans, wanted to share our experience. We actually did try to source bank loans, and what we noticed was that WATC Master Lending Agreement actually says that they have the first charge over the rates for all of their loans, even subsequent loans after the bank has given us a loan. So that actually caused major concerns with the banks, and that's the reason why banks are not too keen.
Okay, thank you.
I think, Paul, there's one question that came through when we were doing the program, and I don't know for who this is, the Superannuation Guarantee Act and the ATO.
I think the actual query is around annual leave loading, if I'm not mistaken, yeah. So basically, it's nothing new. The rule, from superannuation guarantee came up in 1992, as most of you will know. From 1992 till 2008, we did not have to pay super guarantee on annual leave loading. Annual leave loading. Okay, but in 2009, they changed the definition of ordinary times earnings. So, in a nutshell, if you are paying annual leave loading on your employee's leave, which isn't related to overtime, that leave loading is subject to superannuation. Okay, so the only exemption from super for annual leave loading is where it's referable to overtime work. So again, this isn't anything new. It's been there since July 1st, 2009. In case you're not paying super on leave loading, I suggest you get in touch with probably Volga Tax, and we can help assist with it. Because just bear in mind, the risk with unpaid super is just increasing now, because with the introduction of SuperStream, the ATO have live information. They know exactly where you're paying super, how much you're paying super on. So I think in a couple of years, you'll just start seeing the ATO just rolling out audits. So it's a good time to get your house in order. So have a check of all your codes on your payroll systems and make sure you're calculating super correctly. Yeah?
So I think we'll leave it there. Can we all thank the team at Moore Stephens?